First thing you do is look at the trial balance. If the trial balance has an account called loan payable bank, and your client says, oh, it's management use only, I think we can safely assume it's not management use only. You can safely assume the bank's probably going to ask for these. Would you agree? Okay, think of a lot of your smaller clients. For most of them, the only third-party liability is probably accounts payable. Does that sound right? Now, is it possible that vendors could ask for, is it possible a vendor asks for the financial statements? Yes, so that would be third-party use, so that one could be tricky. But again, what would happen? How would this play out in reality? Think about that possibility. You've followed the book and everything's done properly, management use only. All proper. Legitimately, a couple months later, your client decides, you know, I need a bank loan. Goes to a bank. Well, what's the first question the bank's going to ask? Do you have? Right. And your client, in theory, will say, I do have financial statements, but I cannot share them with you. I need to go back to my CPA, pay them more money, and get a regular report. And of course, that's the way it'll play out, right? No, obviously not. So what'll happen?
Cover up the little blurb.
Of course.
Copy them.
And then at the bottom it says management use only, but you can white that out, right? So the client will say, here, my CPA audited these. And then you'll get a call from the bank. About these statements you audited for X company. What statements that I audited? And then you'll call X company management, your client, and you'll say, what's going on here? This is management use only. How did the bank get a hold of this? Now, think of your clients. Some clients will say, I gave it to them. Ha, 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 we can do about it. Other clients will say, I don't know how they got it. Had a party and they were spread out on the table. Here. Number 5, yes. Okay. Historical financial statement or statements taken as a whole. Audit, review, or compile. Anything else is under the attestation standards. Agreed upon procedures come under the attestation standards. In other words, can you do an agreed upon procedures engagement on a financial statement, historical financial statement taken as a whole? No, you cannot. It has to be audit, review, or compile. Okay, client says, I want you to deal with my historical financial statements taken as a whole, and I want you to do agreed upon procedures. The answer is no, you can't. I can't do that.
Two separate engagements.
Well, you'd have to have, yeah, right, I've got to do an audit, review, or compilation on the historical financial statements. So I can't do that with agreed upon procedures. Client says, here's $5 million, I want you to do it. Then what do you say? Well, what you say is, I can't do it. Professional standards will not allow it. Now, is that how it would be playing out in the real world? Right? I guess if for $5 million, you'd find a way. How's that sound? When you do a comp and they leave out footnotes, you add in an extra paragraph that says management has elected, etc., to omit substantially all disclosures, but you don't specifically say which ones. It's just open-ended, substantially all disclosures. Whereas, let's say there are footnotes.
Well, the only disclosures you would have at that point would be anything that's parenthetical, like allowance.
Yeah, there would be disclosures. That's why we use the word substantially all. Because when you look at a balance sheet, you hand me a balance sheet that says inventory, paren, FIFO, $100,000. Aren't they disclosures? Yeah, those you'd have. So we mean footnotes. That's why it says substantially all disclosures. It doesn't say all, because there are disclosures on there. You're absolutely right. That's an interesting technicality. So audits you will be doing the winter of 2013. The Clarity Project is effective. Okay, now, go to page 26. The purpose of this, the AICPA did this project The idea is to issue the audit standards. Now, interesting, this is just the SASs. It's not the PCAOB standards. To issue the audit standards, to reissue them all and clarify them. And some they're changing the format, some they're actually making substantive changes. You'll see what I mean as we go through this. The idea is to issue them so that they are easier to read, easier to understand, and therefore easier to apply. That's exactly right. Okay, that's the thought process. Now what they did was they reissued all of the old SASs, most at least, not all, because some are already the clarified standards, as SAS 122. So SAS 122 is pretty much most of the old ones. SAS 122 is about 800 pages because it includes so much in it. And then they have a couple SASs since then. I've shown you titles here. Now, I show you sources. What I did was I ordered the SAS 122, which also included 123 and 124. And 123 and 124 were like 3 pages each. 122 is the biggie. And the different sections that I'll point out to you. And also this AICPA Audit Risk Alert, Understanding the Clarified Audit Standards, which is very good. And also I use the website. So here are my sources. The website, which I listed here, which you can check out this weekend if you'd like. Previously issued standards, SASs, that were actually part of the Clarity Project. Okay, if you go to page 27, overall objectives of the auditor. Now, let me ask you a question. When someone says, do you generally accepted auditing standards, do any of you think of the 10, the 10 generally accepted auditing standards? Remember training, independence, due care? Do you think of that? Did you memorize that for the CPA exam? I know I did. Okay, I always thought GAS meant those 10 things. Now, in the Clarity Project, they don't have those 10 things. And I got very upset, and I called the AICPA. I found the name on the list of a person that I met at a conference once. So I called her. She's been actively involved in this project. She's very passionate about it. And she said, GAS includes everything. All the standards are part of GAS. And they didn't list the 10 things because everything is GAS. And if you follow all the standards, you are by definition pulling in those 10 things. So it isn't necessary to list them separately. See my point? Now, I always thought GAS was the 10 things. And that's what I always told people. And this is what she said to me when I was talking to her on the phone. She said, GAS always was everything, not just the 10 things. And then she said, some people thought GAS was the 10 things. Now, I didn't say I was one of those people. I just said, oh, how you like that? That means I've been telling people wrong information all these years. How you like that? And I've given you the source here. Overall requirements. Now, you see where it refers to AU-C? You know how auditing standards are in professional standards AU? Agreed? What they did was the Clarity Project, they gave the numbers AU-C. Why? Because there are some Clarity standards yet to be issued. Not many. They're expected to be issued in 2013, which means by 2014, all of the Clarity standards will be issued. AU-C will become AU, and the current AU becomes history. It disappears. Now, another point. The numbering of these section numbers under AU-C is consistent with the numbering under ISA. What's ISA? We mentioned it early this morning. International Standards, the other word, International Standards on Auditing. So in other words, the U.S. numbering of the sections in auditing for SASs is consistent, will be consistent with the ISA numbering. Determine whether the financial reporting framework is acceptable. Now, what's that mean? As I said, I love reading something and translating it to English. They're using the generic term, financial reporting framework. Okay, in many cases it will be, I gotta talk louder because Friday afternoon people are tired. Is it bothering when I talk real loud?
It gets a little loud, but it's fine.
I'm sorry.
Oh, it's okay. No, that's fine.
Mostly it'll be US GAAP, but it could also include other frameworks, and we're going to see some in here. Okay, obtain the agreement of management that it acknowledges and understands its responsibility. Now, think about what that says. What's that mean? Agreement of management. What do we call that? Doesn't that sound like an engagement letter? But it doesn't say engagement letter, it just says agreement of management, which leaves it kind of open. How else would you do this? I mean, I guess you could do it with a verbal discussion and then you summarize the verbal discussion. But it seems if you don't have the client sign off on it, it loses something, right? You know, this is my understanding of what we discussed. Well, babe, that's your understanding, it's not my understanding. So that's where the signing off really makes sense. And with documentation. Do you find documentation a pain in the neck?
Sometimes.
Okay, seriously. If you answer that question by saying that, I never find it a pain, you know what that means? You're not documenting properly. It's a pain, there's no question about it. It's much easier for me to think it through and then explain it to you verbally than go through all of that, right?
Easier than getting her,
But you know what? That's a good point too. Now, it's given a substantive change category. Okay, so let's go over what this involves. It involves, during the course of your audit, you identify deficiencies in internal control. This is all what it is now, and that stays the same. Deficiencies, agreed. Some of these climb up to SIG, thank you, sir. And some of these climb up to, wait a minute, how many say Dave's going to get it right? Oh, come on.
Material.
That's exactly right. And the people who did not support him, I am ashamed of
We'll
you.
just get a review.
You'll get them. Make a list of who it is. Okay, what's the SAS 115 letter? Anything that has climbed up to a significant deficiency or to a material weakness, to be a material weakness that has to go through significant deficiency, has to be cited in a written correspondence to whom? Those charged with governance. Usually management also. Okay, now, what are they doing here? You see what I underlined? The clarified SAS adds the following requirements. Now, let's go through these. Start with the second bullet, and you'll see why in a minute. The requirement to include in the written communication, what's that? That's the old SAS 115 letter. That's the written communication. An explanation of the potential effects of the significant deficiencies and material weaknesses identified. The ASB believes management and those charged with governance need this information to enable them to take appropriate remedial action. Who's responsible for taking the remedial action? Who has to fix it? Management. Those charged with governance, probably a board or an audit committee. Again, oversight. Hey guys, fix it. And then I'm going to come back and make sure you fixed it. I mean, isn't that what we're saying here? Read on. I lost my place. Thank you. Further, the ASB does not believe this requires additional effort by the auditor. Now, this is going to hit you. Because the potential effects would have been considered as part of the evaluation of the severity of the deficiency. The clarified SAS includes guidance addressing potential effects need not be quantified. So what are they saying? There's a distinction between deficiency, significant deficiency, and material weakness. Significant deficiency has a significant, or actually a material effect on the financials, and material weakness has a pervasive effect. They're buzzwords they use. So what are they saying here? They're saying extra information has to be put in this SAS 115 letter, but it won't be called the SAS 115 letter, agreed? Extra information has to be put in, but what's ASB saying about that extra information? They're saying it's really not that big a deal. Why? In your documentation, you should have something which shows that you went through this to determine the severity. In other words, is this going to be a significant deficiency? Is this going to be a material weakness? You had to have gone through some procedure, that's what they're saying here, to determine that. So it sounds like what they're saying is take what's documented and put it in a letter. That's what it sounds like they're saying here. Okay, what's the written communication? Significant deficiencies and material weaknesses. So anything that just met the category of deficiencies. Now, this sounds very similar to, did you ever do a management letter where you said, these are some weaknesses we found in internal control and here's what we recommend you do? That's what it sounds very familiar, because I'm reading this as just deficiencies. But let's look at that first sentence, because I think this is very important. In writing or orally, you have a choice for this communication. The written communication, the one that's the old SAS 115, has to be written. This one can be written or oral. Now, if you do it orally, then what do? Anything that's an oral communication, you document it. But of course, it seems to carry more weight when it's written because, oh, I told you. I don't remember you ever telling me that. You know, that's so. In writing is your safest approach. Only to management. What does that mean? See, translate the clarity into a clarified English. Okay, but you see, the question is, could you distribute this to those charged with governance? See, I think you could. What they're saying is, they're not requiring you to distribute this to those charged with governance. Like management might say, yeah, I understand this issue, it's not a significant deficiency, and for whatever reason, I don't want the board to know about it. Now, you got to be satisfied that no games are being played here, and that's fine. This communication only has to go to management. If you want and can give it to the others, fine. You're not prohibited, but you're not required to. Whereas, go to the second bullet. The written communication must go to management and those charged with governance, right? And this is nothing new, but it's worth mentioning. On page 48, the auditor should communicate in writing to those charged with governance on a timely basis significant deficiencies and material weaknesses identified during the audit, including those that were remediated during the audit. What's that mean?
They haven't balanced cash, also balance.
Okay, in other words, here are some issues we found. There's significant deficiencies or material weaknesses. During the course of the audit, they fixed this up. Okay, you still have to communicate it. Client's going to say, why are you telling them that? I fixed it. And you will say, well, it's a requirement in the standard. Now, could you in your communication say this has since been remediated? Yeah, that's fine.
This has been brought to management attention, they've changed the
And they've
policy.
changed it, and that's right, because it also shows people are paying attention to what's going on here. So that's actually a positive in that respect. You know, if you think about it that way.